I've been trading and surviving in the market for 14 years. I've turned more than 40,000 traders. And along the way, I've met a lot of successful traders who put in six figures a month. And after meeting them, I learned one thing for sure. All traders use the same strategy. They even trade the same capital, the same instruments. However, while some withdraw every day, the others watch their accounts melt away. Why is that? In this video, I'm going to show you from start to finish why the results are so different, even when the strategy and the capital might be the same. By the end of this video, you will see exactly what separates the trader who withdraws every day from the one who doesn't. And starting tomorrow, when you open your chart, your trading is going to be completely different. The first one is how you look at trading. When you first start trading, it's easy to believe that every trade has to go your way for you to make money. You tell yourself it has to bounce here, it has to break out from here. You think the market has to move exactly the way you drew it for you to make money. But traders who withdraw every day, they start by accepting one fact. Nobody can predict the market. Nobody knows what the next trade is going to do. There is no set algorithm, nor there is an AI that predicts exactly what to expect. Not institutional players, not the dominant side. Nobody knows the next candle. So how do they make money? It's not about getting one trade right. It's about building a structure that makes money overall, over 100 trades, 200 trades. For example, let's say you have a very simple strategy. You only enter when price gets support at a moving average. You take this 100 times and 51 of them win. 51 wins out of 100 doesn't sound like much, right? It just means you win 1% more than the market average. But the trader who makes money, once they find a strategy like this, they execute it relentlessly. Because over time, these small ads will accumulate in their account. If you trade 100 times, you will win 51 and lose 49. That's only 2 trade difference. But if you trade 10,000 times, you will win 5,100 and lose 4,900. That's a 200 trade difference. That 1% that may seem like nothing will pile up in your account the more you repeat the trade. Traders who withdraw every day know this. That's why they are not emotionally affected after losing 1 or 2 trades. The second one is when you decide first before you press the entry button. Most people look at how much they can make before they enter. You tell yourself, if I catch this, I'll make $600, or this will cover my rent for the month. But traders who withdraw every day, they already have 3 things locked in before they enter. First, how much capital they're pouring into this trade. Second, where they cut it in the worst case scenario when the stop loss hits. Third, when it gets there, how much of their total account is lost. The third one is the most important here. For example, on a single trade, how much of your total account can you afford to lose? If you are a trader who is not constantly profitable yet, you should not lose more than 1% of your account on a single trade. You might be thinking, come on, if I only risk 1%, when am I ever going to make money? However, here is what this 1% really means. 1% is not the number for the maximum profit. It is the number for training your behavior as a trader. If you can hit the stop loss button at 1%, you will never hit it at say 3%, 5%, or 10%. A finger that trembles at 1% cannot be steady at 5%. At 1% is the only zone where you can train your hand to take a stop loss. Let me show you with actual number. If you only lose 1% at a time, you can take 10 stop losses in a row and still have more than 90% of your account left. But if you start losing 20% at a time, 3 stop losses and half of your account will be gone. The goal is not to make big money on a single trade. The goal is to make sure one loss doesn't blow up your account. This is the one law that traders who withdraw every day actually follow. The third one is they don't treat a single trade as something important. Traders who withdraw every day, they know that one individual trade really doesn't matter. What actually matters is the combined result of the next 50 trades, the next 100 trades. Let me ask you something. There is one trader who made $100,000 in one trade, and there is another trader who made $10,000 over 100 trades. Who is more impressive? We would go crazy over the trader who made $100,000 in one trade. But from the perspective of traders who withdraw every day, the trader who made $10,000 over 100 trades is far more impressive. Why is that? One winning trade might just one lucky moment. There is no guarantee at all. Then you can't keep making money like that. But if you made money over 100 trades, that is real proof. Then you can keep making money this way moving forward. Say a lot of people try an RSI strategy from a book 2 times, both stop out and then throw away the strategy, right? But let's think about this from the perspective of a pro. You are using this strategy for the first time in the exact spot. One time, at most 2 or 3 times, with one result, you can tell whether the strategy actually works or not. It might have just been a spot where it didn't fit at that moment. Whether a strategy really works or not, it can only be judged after 100 stacked up. Until 200 trades are filled, there is nowhere anywhere in the world to tell the difference between luck and skill. And let me give you one pro tip here. Have you ever tested a strategy on a chart? You pull up the past chart and ask yourself, what would I have happen if I bought here? This is called backtesting, but not many people do backtesting properly. Most people pull up the chart and start from the right end, which means from the most recent price, and go backward into the past. You tell yourself, I should have entered here, I should have cut here, but that would not be backtesting. This is just looking at the result when you already know the answer. Think about it. When you read the chart from right to left, you already see how the chart has moved. So the entry point looks really clear. It looks like you would have been stopped out. Everything looks like it would have worked. But this is an illusion. Real trading happens when you don't know the future. So backtesting has to be done from left to right. You start from past point in time and you trade as if you were only looking at the chart as it was back then. You ask yourself, if I were here right now, would I enter? Wait, a trade was already in progress yesterday, so I couldn't have entered today. On a chart, the result of any single trade sits on the continuous line of every trade that came before it. So you can't just pull one trade out and ask, why doesn't this work? The fourth difference is how you accept a loss. When you take one stop loss, your brain naturally starts making excuses. You tell yourself, the 1 minute chart doesn't suit me, or Nasdaq doesn't suit me. You are accepting the loss as a failure, but traders who withdraw every day, they accept the loss as a business cost. How is that possible? They know they own trading as a statistic. They know where they have to cut and how far they can hold it before it turns into a profit. It's all written down in their trading journal and they move by that rule. Even the best traders in the world take losses on a regular basis, making a loss unavoidable. Let me give you an analogy. You see a ton of ads on Instagram and YouTube, right? Do you click on all of them? No. But the advertiser doesn't stop running the ads. They keep going. It's because if they show it to 100 people and only 10 of them buy, that's enough. But here's what's important. If 10 people buy, that means 90 people don't buy. In that case, is the ad money spent on those 90 people a failure? No, it is just cost that comes together with selling to the 10 people. In trading, taking losses is exactly the same. The cost you pay in advance is to create a winning trade. That is what a stop loss is. You take 5 trades, 3 win, 2 stop losses. If the total profit is bigger than total loss, those 2 stop losses are not failures. They are the cost you pay alongside to create those 3 winning trades. I told you I've met many traders who pull in 6 figures a month. Among them, let me share the story of one particular trader. Before he had been trading for even 6 months, he turned $1,000 into $100,000. But before he got there, in his first 3 months, he got liquidated more than 30 times. He was getting liquidated almost once every 2 or 3 days. The reason he could still be in the market after 30 liquidations, which is the real key, was because he only traded with $1,000 at a time. Not more, not less, no exceptions. $1,000 when he won, $1,000 when he lost. He didn't put in his entire capital all at once. He set his loss cost in advance and then trade. That is why he could survive 30 liquidations about leaving the market. Had he put in all his capital without calculating the loss cost, it would have ended at the second or third liquidation. He thought to himself, this is a process I naturally have to go through. And because he accepted those 30 liquidations as a cost and not loss, he was able to reach the point of turning $1,000 into $100,000. Whether you see a loss as a cost or as a failure, whether you calculate that cost in advance and trade or you don't, that difference is what built him into a 6-figure-a-month trader. The fifth difference is they know how to wait. A lot of people, when they look at the chart, their hands move before their mind. You tell yourself, I've seen this pattern before, another moving average pull back. And then you press the entry button. It's because when a pattern shows up and you don't trade, it feels like you are losing out. This is just matching patterns. You enter anytime as long as the chart shape looks similar. But traders who withdraw every day, they do not enter based on the chart shape alone. They ask themselves, am I in my trading time zone right now? Is there an opposite signal on another time frame? Are the moving averages in a bullish alignment on the daily? Is the current daily candle bearish or bullish? Is there a data release or a new session opening within an hour? Did my entry point actually alive? They learn all of these through their filter and they only enter when that exact spot appears at that exact time. For example, on this chart, if you enter just because price pulls back to the moving average, it often breaks through and goes down. But what happens when you enter only when the time and the conditions all line up? Let's look at this chart. This is a Nasdaq chart. You are looking at a pullback to the moving average as a buy entry point. So you check which pullback, this is the sequence. You check whether the current time is within an hour of the US Open, whether the daily candle is bullish, whether the daily moving averages are in bullish alignment, where a data release is scheduled. You confirm all of these before entering the position. By doing this, you can enter at much better point than just matching pattern. Like this, traders who withdraw every day have rules and principles that do not change. No matter what spot comes up, no matter what situation comes up, they judge by the same standard. That is why their trading results have a consistency. The last one is one unit you operate your trading on. Most people want quick profits. This month, next month, you want to make big money fast, right? But traders who withdraw every day, they operate trading like a business. A successful business owner does not open 2 more stores next month just because this month's revenue was good. Because they know 1 month's revenue has high volatility. They expand stores on a 1-year business plan. Traders who withdraw every day are exactly the same. Just because this week was profitable, it doesn't mean they double their account next week. Just because they took a stop loss today, they don't change their strategy. Just because this week was bad, they don't quit trading. They operate like a business on a yearly cycle, and they look at their trading on a monthly or quarterly basis. This is the mindset of a successful trader. Everything I've shown you so far, this is the sequence that traders who withdraw every day go through in front of the chart. Let me be honest with you. Knowing this in your mind doesn't mean it comes out in real trading right away. It didn't happen for me in a short time either. But once you start training to cut at 1% every day, once you stack 50 trades, 100 trades, once you start accepting losses as a cost, this sequence starts getting locked into your mind and works on any market. I cover this step by step in free YouTube video on my channel. If you don't want to miss any of it, hit subscribe. Thank you for watching.